In this video, we're going to talk about rejection blocks. So rejection blocks basically, to think about it guys, you have to look at the candlesticks. Most of the time, you'll see rejection blocks forming when we have a rejection on the opposite side of a trend. Like for example, on this one, this is what we call a normal rejection, because we can see that this candlestick here and this one, we have a rejection with this candlestick, but the close of this bearish candlestick and the open of this bullish candlestick is the same. That is why we call this a normal rejection block. So this one is a gap rejection block, because we can see that the close of this bearish candlestick and the open is not on the same price level, because we have a gap here. This one will happen mostly in lower time frames, and then you will also see them mostly on Monday, because as we know, the market will close over the weekend, and then on Monday you are probably going to see some gaps in the market. So this is where you will find these gaps. But and then also, if we look on this one here, we have the engulfed version of a rejection block, because we can see that the body of this candlestick here is bigger than this bearish candlestick's body, and we can also see that the close of this bearish candlestick and the open of this bullish candlestick is the same. And if we look at the body, we can see that the open here and then the close here, this one is having a bigger body. So to understand this very clearly, it's not even that difficult. So right now, let's look at the candlesticks here. If you look closely, we have the move to the downside here on this week. If you look at the wicks, you'll understand this very easily. And also look at this wick here. You can clearly see that the push to the upside is very aggressive, even though the market started by going down and then it pushes to the upside. This is what we call a rejection. So this will build up a rejection block. So most of the time, you have to look at these candlesticks here at your key reversal point. Like let's say right now you have an order block and then the market is doing something like this. Let's say you have your order block around this area. I'll just make a line here to demonstrate. And then let's say you are looking to enter the market around here. So you will be waiting for the market to do the same thing using this candlestick patterns here. But we don't necessarily have to do this. We are going to use these candlesticks as our higher time frame analysis. If you look closely, I have put some red lines here so that I can demonstrate where the reversal might occur in the lower time frame. This is where you'll be looking to enter the market. You can use this candlestick on the close as your reference point to enter the market to the upside. And also, if we have a gap like this one here, you can use this close or this open as your reference point to enter the market in the lower time frame. So you'll be looking to enter long here in the lower time frame. Let's say this is the 4 hours, and then you'll be looking to enter the market maybe in the 5 minutes or maybe the 15 minutes. The same applies on this side here, but for the engulfed version, you are most likely going to miss this one, or maybe the market won't even reach this area, because the market is likely to reverse around this area and move to the upside based on this engulfing candlestick alone. So, and sometimes it doesn't have to be this bullish candlestick. Sometimes this candlestick can still be a bearish candlestick while the market is going to reverse. You just have to focus on reading these wicks here. So let's look at another example. We can clearly see that right now, on the gap version here, we have a bullish candlestick, where else we are looking for the market to shoot to the downside. So in this situation, that means you'll be looking for the market to come and retest this area. But in this case, I have put this candlestick here to show you that the market has already retested this area. If you look at this candlestick alone, you can clearly see that the market is trying to push to the downside, even though we have a bullish candlestick here. So you have to think about it in a direction where the market is likely to push. And also, you can clearly see that this one is just a normal one, because you can clearly see that price traded above this previous high and then close bearish. And you can clearly see that we have an aggressive move to the downside. And on the previous video, we talked about this kind of candlestick pattern. So I'll put the video in the description below so that you can check it out. And here we can see that we have the engulfed version. So that means you'll be looking for the market to come to this area and then look for a sell. This will be your higher time frame analysis. So in this situation, in the lower time frame, that means you'll be looking to enter short here. The same applies on this one. And another thing, because we have a gap here, that means this candlestick will act as our reversal area in the lower time frame on the close, but we also can try to enter the market around this area. I hope you understand it on this one, guys. So let's look at a more practical example so that at least you can understand the structures. You can clearly see that right now here, price looks like is gaping. If you look closely on this price section and this price section here, the opening price of this, the closing price of this candlestick and the opening price is not the same. It's not the same. So we can either choose the closing or the opening price of this candlestick as our reversal point. And we can clearly see that the market paused a little bit, and then this is just a consolidation. The market was like this. And then on the next candlestick on this one, it shows that it broke this high, it moved to the upside aggressively, and then it started to move lower. Sometimes price can take, what I mean is that on the rejection block, price can trigger the trade on the next candlestick. Number two, it can pause a little bit, or maybe it can trade after one candlestick, and then thirdly, the market can take a little bit of a while, maybe let's say after maybe six or 10 candlesticks, or even more. So you just have to put that in your mind. So based on this one, you can clearly see that the market made a rejection block around this area, and then it took a little bit of a time before we can see another rejection here, and then price trade to the downside. And then if we look closely around this area, you can clearly see another rejection here. And then on this next candlestick, the market just triggered it. That is why you see a move to the downside. So right now, I want to show you a little bit of a difficult pattern. I want to show you 3 examples of key levels. We have this low here, and then we have this high here. And then we can clearly see that the market is fighting here. Most of the time, this one, I'm trying to avoid it at all costs. But if you want to trade it, it's on you right there. Unless if you have a better strategy to trade this kind of candlestick in the near future. So what I want to point out is that you have to wait for the market to move to the downside, break this low, and then wait for price to come and retest this area, or even this area here, because sometimes price can react on the previous candlestick's high. So you have to wait for the market to break either the low. So sometimes the market doesn't even break the previous high. Price will just move to the downside. Here we have a lower low, we have a lower high, we have a lower high. So we can clearly see that we don't even have a break of market structure, but price ended at this area. In this situation, we have to look at price before we have this lower low here. We have to watch if price already broke the previous low here like this. And we can clearly see that price manipulated this low, but it went straight into the range of this bearish momentum. So that means here you will be looking for the market to trade around this area, and you can clearly see that the market touched this area and it started to push higher. So it's either you choose to enter the market with this candlesticks close. This will be this candlestick. What I mean is that when this candlestick closes, you will be looking for the market to push higher around this area. This is your reversal point. So most of the time you'll see this kind of setups when the market is very strong to the upside. If not, the market will just give you price action to show you that it's not willing to push any lower. Price action will tell you a lot of stories. Another one is the one that checks out the sell side liquidity and even the buy side. This is where you don't even know where the market is going, because it will be like this. It breaks the low, it breaks the high, and sometimes it can even break the low again and even come down like this before you can see a move to the upside. But in this situation, we can see that we have only a high, this high here that is being broken by this strong move. And you can clearly see that after this strong move started around this area, and then the market never stopped being bullish. This was just a retracement to the downside. This move here, if we move on to the lower time, if you move on to the higher time frame, you'll see that this is just a huge candlestick. And then the next candlestick might possibly retrace back and then continue to the upside. You have to watch this kind of moves. And you can also see that we have a demand zone from this candlestick here. So that means you will be looking to, because we have this candlestick here, you can look to enter on this open or even on this candlestick's close. And you can clearly see that this candlestick is bearish. But if you look at the momentum here, you will see clearly that we have a rejection. The market is telling us we are rejecting. We don't even want to push any longer to the downside. And before price, let's say this is your higher time frame. This is your higher time frame, okay? That means in the lower time frame, before the market can reverse here, you have to see a consolidation, and then this move has to be strong before you can use your price action techniques to enter the market. This will look something like this for a reversal to the upside and then a reversal to the downside. And this setup's aim is to catch the low or the high of the next candlestick. So from here, let's say this is your lower time frame. You will see that line around here. This move has to be very aggressive and then it has to reject. It's like maybe something like this, if I want to put it out. Yes, it's like something like this. Let's say you want to enter the market around this area. You will see that when you move on to the higher time frame, your trade will be around this area here, because you traded this move to the downside, and then suddenly when price shoot to the upside, you will be in a trade, and then this is your entry. Your entry will be around this areas most of the time. This will be your next candlestick. You'll see that price is rejecting. So for example, it's like this. Let's say right now the market is shooting to the downside very aggressively, and then you enter the market here. Then the market moves to the upside. This is what we need. So the same thing will apply on the sell side. This price action here has to be very strong to the upside before we can see a move to the downside. Let's look at an example here. You will see how the market will move. You can see that here price is just ranging. And when price, this will be your higher time frame point of interest. And also you have to see that before price can touch this higher time frame line, it has to break the previous low. Price will never be in a range when your point of interest is there, is available. And you can clearly see that this candlestick here, when it touches this higher time frame line, it rejected very quickly and then it started to move lower. But then you don't have to be afraid of this kind of moves. They happen every time. So let's look at the previous example with the lower time frame. This is the previous example that we were talking about. This line here, never mind the different color, is this one here. You can clearly see that price even crossed this line, and then we have this move here. This is where you should consider to enter the market to the upside, to break above this higher time frame. This is the higher time frame high. Okay, it's not very difficult to understand this, but we will try to do some examples so that you can clearly see the benefit of doing this. This is the 3 hours time frame, and then you can clearly see that we have this rejection block here is covering this candlestick, and we can also see that okay, the rejection block is above this previous high here. So that means we are looking for the market to break this high, and also we can see that price manipulated this low here with this candlestick. So that means we have 2 lows here. So in the lower time frame here, you will be looking to enter the market short. So let's look at the lower time frame and see how the market looks like. Right now we are on the 5 minutes time frame. You can also use the 15 minutes, but most of the time I would like to start at the 5 minutes and then going higher to the 15 minutes, or even lower to the 1 minute, or even the 3 minutes. It all depends on the analysis. So we can clearly see that this low here was manipulated here with this low, and also this is the high that I was talking about, and price just shoot to the upside, touched the rejection block here, and then made another candlestick. That is why you see a move to the downside, and this will give you a lower risk entries most of the time. You don't have to wait for a breakout here to put your huge stop loss like this just to catch this. This is not a good risk management. So let's look at another example. If we look at this example here, we are still on the 3 hours again. Here we have the engulfed version of the rejection block. You can clearly see that this move is very strong. And then in the lower time frame, you have to spot something like this. You will see that the market broke this previous high and even broke this previous low. And then this will be your correction, or maybe a consolidation. Whatever you want to call it is fine, it's the same thing. So by looking at this candlestick, as I said before, price has to be very aggressive to the upside before it can shoot lower. Like if we look at the previous example on the 5 minutes, look here guys, price was very aggressive to the upside before it can touch this area, before we can have this rejection. So even here we can clearly see that we have a huge candlestick to the upside. This is what we need, because most of the people will be looking to go long. And most of the time when price is going to reverse, you will see a very strong move to the opposite direction. Even from here, by looking at this example here, you can see that price was very, very strong to the downside, and then it started to reverse. This is what built up a rejection block. So let's look at the lower time frame. In the lower time frame, as I said before, we have this high here. Price has to break above this high and then touch this area. And after touching this area, we have this rejection. If you enter this rejection here, maybe your stop loss is around here, you will still see some drawdown around this area. And then if your stop loss was above this high here, above this candlestick's high, that means you will be stopped. But if let's say right now, you see on the market that okay, price is in this area, then you can wait for another rejection, or maybe use another different confirmation to enter the market so that the market can shoot lower to the downside. Because if this candlestick was around, let's say this area, or maybe let's say this, let me explain it properly guys. You see this candlestick here, and let's say these candlesticks here are above this area here. That means right now we won't even take this entry because price did not trade above this high. Then we have to wait for this candlestick to break this high so that we can enter the market to the downside. So it's very simple that way to understand it. So right now, let's look at another example so that we can at least make this very clear. This is the 4 hours time frame. This is the 15 minutes time frame. Let's look at this area here. As I said before, price has to be very aggressive to the upside before it can reverse. And based on this price action, that means we will be looking to enter the market short when price retests this area. And for example purposes, if let's say you have something like, let me see, something like this one here, where price on the next candlestick retest this area, I will avoid this one in the near future because it has already been retested. This one did not retest with this candlestick here. That is why it's very valid. And then in the lower time frame, we can clearly see that we have this high, we have this high, we have this high. So that means right now we are waiting for the market to move to the upside very aggressively. You can see this candlestick and then started to show some rejections here. This is where you'll be looking to enter short because price has already traded above the rare highs. Okay, and then you can clearly maybe put your stop loss around this area, but you can use another different types of confirmations. Like if we look closely here, you can see that you can wait for the previous low to be broken first to make a break of market structure like this, and then wait for the market to come to a supply zone so that you can enter the market short, like on this area here. And you have to take only the first reversals. Other than that, you don't have to wait for the market to do something like this, unless if you are willing to add some more trades into your setup. And also this can also be done in lower time frame. Let's say this is the 5 minutes time frame. You can also use this method to enter the market in the lower time frame without even using so many complicated things. We have this low and then we have this low. It goes to show that the market is bearish. And then also we can see the rejection block here, and price went to the rejection block very aggressively, and then we can see a rejection candlestick here. That is why you see this very strong move to the downside. Price has to be very aggressive. It doesn't have to be very slow. Like if you see this kind of candlesticks coming to your zone, that means you are most likely to see price action to do some silly moves. It can do something like this, and then suddenly you can see a huge candlestick to the upside. But if it crosses your rejection block, avoid that setup. And even in this area, you can clearly see that we can have a rejection block here, and we can say that price really above this high. You can say this is your buy side liquidity, this is your sell side liquidity, and then price even broke the structure here. So right now you will be looking for the market to go long. But look at this candlestick. It's very aggressive to the downside. And then suddenly we have this bullish engulfing candlestick. That is why you see a move to the upside. Okay, that's how you should at least try to understand it. Let's look at another example. You can see we have this high, we have this high, we have this low, and price here, we have the rejection block. Let's say this is the 5 minutes or even the 1 minute time frame. Price is also will always print out the same thing even in different time frames. So from here we can see that before the market can touch the rejection block, you can clearly see that this candlestick is very aggressive. And even this one, even the last one, you can clearly see that price is very aggressive. Then suddenly price touches the rejection block and then reject here, and then it closes bullish. So that means you can enter the market with this candlestick and then watch price move into the upside. This is how you should at least try to understand it. You can use it on there. For example, you have two options here. Option one is that you can use it from the higher time frame to the lower time frame. This will be your analysis time frame, and then this will be your entry time frame. And then option two is that you can also use this in the one time frame, meaning you can use this in the 15 minutes time frame only, or even on the 1 minute time frame only. Okay, I hope this video was not even that difficult, but if you have some more questions to understand this very clearly, because on this video I didn't even cover the trade where it will fail. Let me just look at this chart very clearly and see where the market will try to fail, because we can see this one worked out perfectly. Okay, this one here, price just dropped, but we don't even have a confirmation, so that means no entry, no losing money here. I'm trying to find another one where even if you try to take this one here, there's no confirmation because price also traded below the rejection block. Where can I find another one? Let me try to find it very quickly. Okay, I believe I have found it here, because sometimes the market will do some silly moves. Let's say right now, because we don't see the market the same way, this is the high, price shoot to the upside. Then when it comes down, let's say you pick this one as your rejection block, and then you see the confirmation, and as I said before, price has to be very aggressive to the downside, and then you enter the market here. Then suddenly price shoot to the downside, and then it moves to the anticipated direction. You don't have to force things. The market will give you your things back if you follow your own trading strategy. So guys, if you have any questions, please leave a comment below, and also you can come to our Telegram so that you can always talk to me. I'm always there. And also don't forget to subscribe to the channel. We are on the road to 30,000 subscribers. I guess traders, I'll see you on the next one. Stay safe and always use a stop loss. Other than that, we'll see what the market can do to you.